If you don't know me, my name is Steven. If you know me, that early on in life, I decided to dedicate my time to helping people out. I chose to major in politics and pursuing a career in politics because I believe that changing laws is the best way to help the most people. This is not the most stable or lucrative field, so I have to be smart with what money I have or what money I earn. Okay. In politics specifically, financial independence or stability is very important to being able to speak freely, um, where you don't have to feel like you have to censor yourself to avoid offending people or what have you. And this goes for anyone's career or life. You don't want to feel like you're limited um, the way you speak to your employer or potential people you meet because you're broke and you need to suck up to them. So at least my financial goal is financial independence. That's what motivates my financial decisions from here on out. So everybody else, everyone has their own goals, whether it's family, kids, travel, what have you. But today we're gonna find out how to manage our money wisely to avoid stress down the road and being homeless or what have you. Okay. Today, I'm going to first revisit some personal finance that Carmen and Anna had presented a while back, just to get a perspective of where we're at. And then the main part of my discussion will be on a certain investing strategy, which are index funds. And if you don't know what that is, I'm going to introduce it, of course. So there's going to be a lot of information. I'm going to try to keep concise, maybe a break here and there, but if you have any questions, please ask, interrupt, because you might not know what's going on later on if you don't ask a question before in the earlier stuff. So the purpose of this presentation is to inform my audience of the benefits and the merits of passive investing, and to promote financial security, which will give us the freedom to become better citizens. Okay. So here's our basic agenda. Take a quick peek. We're going to revisit our personal finance, and then we're going to discuss financial stability, introduce what stock market is for those of us who are not familiar with how it works or what the concept is. I'm going to introduce indexes and mutual funds, and then introduce the actual strategy. I'm going to compare index funds versus mutual funds. Talk about costs. What are the costs of investing, especially in this strategy? Put it all in a big picture, and then we're going to conclude, and we're going to discuss if we have any discussions. All right. So really quick, this is basic personal finance. Most of it is from Carmen and Anna's presentation, and also a good resource is Reddit, personal finance, stuff that applies to everybody. So first, we're just going to run through this real quick. You want to get a job. You want to track what's you're spending on, what you owe, and what you make, and you want to make realistic goals. Okay. Next, you want to establish an emergency fund that should have at least 3 to 6 months of expenses, maybe 9 if you want to be extra safe. Right. This should cover all of your costs, from rent to bills, feeding your family, what have you. In case you lose your job, you need this time to look for work. So get that set up. And then you want to take care of high interest loans, whether it's credit cards from consumer debt, and then, or whether it's college loans, what have you, anything pretty much. Next, you want to keep in mind any employer retirement plans that they offer. A lot of employers match what you put in, which is literally free money. So if you're not super familiar, again, Carmen's and Anna's presentation is a good one, and we can also discuss it later. Okay. And then we're going to be talking about saving, maximizing your individual retirement account. Again, we're not going to spend too much time on this because that's not the focus of the presentation. But it's simply an account where it's like a pool of money where the government allows every person to have one of these accounts. It's you contribute a max of $6,000 per year, and there are certain tax advantages to this. So you want to maximize this. So after that, you want to save more for retirement, but you can't put into this special account. You just open a separate account. It's just a regular brokerage account. So now you're doing pretty good. So you want to save for anything else. You want to have fun. You want to retire early, what have you. Okay. So we are. The bulk of what I'm talking about today is going to be in this category. Okay, just so everyone's tracking. Okay, so once you're doing everything you're supposed to do and you kind of have things in order, money coming in, you're not like totally lost on your personal finances. Congrats, you got your stuff in order. Now, what's next? On to bigger and better things. Okay. So, the conversation about investing is a conversation about building wealth. Okay. In order to build wealth, you have to acquire assets and minimize liabilities. If this is foreign to anybody, you have to acquire things that will put more money in your pocket versus things that will cost you money, right? So a car loan is a liability because it's going to cost you money over time, right? An asset is starting a business or investments that will put money in your pocket over time, right? Okay. Money sitting in a checking account or a savings account, right? Even though it's nice and it's accumulating with every paycheck, it's actually a waste due to inflation. So here are some figures here. The U.S. government tries to keep it at 2% inflation. Inflation is what happens when the amount of money increases, but the amount of goods that money can buy does not grow at an equal pace. So there's going to be more money, and the stuff that you can buy with it is staying steady or increasing slowly, and that makes each dollar worth less. So these rates right here means that every year you can buy 2% less stuff with every dollar. So if you're leaving your money in a checking account or a savings account, it actually loses value over time. It loses buying power. Okay. So since a dollar today is worth less tomorrow, we have to put this money to work. Okay. Money in good investments will earn you money, and the new money that original money earns should be immediately put to work. You know, you don't just want to put it back in the checking account where it loses its value over time. Okay. Investing is the process of spending money with the expectation of receiving a future benefit or return. Some simple examples are businesses, real estate that you rent out, investing in the stock market, maybe you write a book or something, you get a return on that with your intellectual property. Today we're talking about investing in the stock market. When we're talking about investing, we're always talking about what it will return or how much you're going to get paid back from your original investment. I'm going to explain how stocks make a return in just a second, but for now, we have to take a bit of time to appreciate the value of investing your hard-earned cash to get a return. Okay. The power of investing is found in the power of compounding. Everyone should be familiar with the concept of compounding, but in short, it's where the money you make from your investment is reinvested, so your new money is immediately put to work. Here's an example. The annual return of American corporations averages to 9.5% annually, and this is from 1830 or 1870 or what have you. So if every year you gain 9.5% and you put that directly back into the original investment, these are what the values would look like. If you invested $1, in 10 years the value of that $1 grows to $2.48, and so on and so forth. So you take that change, so it earned $1.48 in the last 10 years, and every year that it returns something, you put it right back, and now you have a bigger thing that grows. Okay, so this is the power of compounding. In 20 years, it's worth $6. In 30 years, $15. 40 years, $37. You'll see that the change from the previous decade, it grows exponentially. That's the power of compound interest. Okay, so what we want to do is we want to maximize this, right? We always describe returns in terms of percentages, and this is what it does. So take a moment to appreciate that, and realize that the earlier you get in, right, the earlier all this starts accumulating. If you want, you could do the calculator thing where you do like $1 times 1 point whatever, but I think we all get the concept, right? Because doing that makes me feel like a sleazy salesman or something. Right? Look at this, it's going up so quick, right? Um, things will always start slow, but the curvature of the rate of return is always going to skyrocket. Okay. Albert Einstein once said that compound interest is the greatest force in the universe, because if you let an investment compound, there's little reason that your kids' kids, and your kids' kids shouldn't be set for life. Um, Given the power of compounding, it's it's not about timing the market to buy when stocks are cheap and selling it when it's high. It's about time in the market. The earlier you get in, the quicker your money can begin growing on itself. Imagine if you put $1 or $2 or 100 in the market 20 years ago or 40 years ago, right? The value would follow this more or less. Okay. And I just have to say, with this in mind, it's astounding that 70% of wealthy families lose all their wealth by their second generation, and by the third generation, 90%. I'll put the source on the website, by the way. It literally grows on its own if you don't touch it, right? So, for those of us who are lucky enough to begin investing early when they're young, it's simply recklessness, greed, or a lack of discipline that will result in you not having wealth or destroying the wealth that your family has, right? If you just invest in a safe investment and let it grow, it'll grow, okay? Okay, so we're gonna move on. What are stocks? We're gonna introduce the stocks and the stock market right now. So stocks are ownership shares in corporations that entitle you to a part of that corporation's earnings. And if you own enough shares in an entity, you will also have decision-making power. Okay. Here are seemingly two ways that stock ownership will make you money. Okay. On the left side is in the long run. Shares in a company will make you money when the company makes profits and reinvests those profits in itself to ultimately create a more stable and capable money-making enterprise. Okay. For example, companies that have good business plans, or if they're leaders in their industry, if they have large market share, if they benefit from laws changing or what have you, or if they're acquired by some other company, and ultimately they are able to make more money in that new environment, that's one way in the long run that owning stock, your stock gains value. Okay. Interrupt me if there's any questions. Okay. And the second way that you get a return from owning stock is when the company that you own, they take their profit. They take like half of it and they invest in their operations, and the other half they decide to give back to its shareholders, and that's what dividends are. Okay, so that's the other way that you will get a return from holding company shares. On the other hand, is in the short run, the other way that stocks provide a return is if the shares that you own goes up in value, and everyone on the market says, "Oh wow, that company's doing so great. We should all buy shares, right?" So a lot more people want to buy that existing share, but the amount of shares stays the same, right? The value of that share goes up, right? So that's the other way that your share will earn you money. Okay. Now, if the shares of the company that you're holding, if that company is somehow perceived to not do well in the future, or they're already not doing well, people are not going to want to hold on to that piece of that company because it's not gonna make the money. So they're going to sell it. Now, when everybody holding that stock says, this is not desirable, I want to sell it, that's going to drive the value of that stock down, and that's how you're going to lose money as well. So generally, the reason for these perceptions, whether a company is going to do good or do bad, these are generally rooted in substantive, real concerns for the viability of that business's long-term business plan. Okay. For example, The top performing stock of 2019 was AMD, which creates graphics cards. Throughout the year, they saw a 150% increase in the value of their stock, in the value of each share. Meaning that if you had $20 worth of share in January last year, in December it was worth $50 per share. If you sold it, you would have made $30 profit off of each share. On the other hand, PG&E was the worst performing stock on the market, and it lost about 53% of its value. If you had $20 worth of PG&E shares in the beginning of the year, in December they would be worth less than $10. When it falls that much, you have some options. You could hold it and hope that somehow they'll recover because they actually have a monopoly on being the utility provider here. So how are they going to lose money? So you might hold it and say, hey, they're gonna do better, right? You might hope that politicians stop talking about taking it over because, if the government takes over the business, then it loses its profit margin, so it's not even going to be on the market. Okay. You might also think that, hey, this stock is super cheap. We should buy some more because it'll recover, it'll grow. Let's get 10,000 more shares, right? Anyways, with the PG&E example, you can see that often there are real reasons to expect companies to be more or less valuable. So you might think that all you have to do is research all the different companies and pick what's the most viable one to invest in, right? That would be called beating the market when you think you can research the winning stocks and do better than the average, okay? You might win, and you might even win big. Like if you put all your money in AMD early in the year, you would have made a lot of money, right? You can do your research. You can subscribe to business journals or finance journals, industry publications, right, to read up on whatever companies you're interested. You can even dig around on the Security and Exchange Commission's website, where all public companies have to report their financial information throughout the year. You can use all this information to try to decide whether or not any specific company in any specific industry is undervalued and therefore a good bargain, good investment opportunity, right? You can put in all this time, or you can just say, screw it, I'd rather spend my spare time, playing volleyball or something, right? So in that case, then you'll just gamble, right? You'll try to buy when the price is low, and you'll try to sell it when the price is high, and that's how you're gonna make money, right? But trading stock and expecting to make money on these trades alone, especially in a short amount of time, is very risky, right? There are obviously thousands of companies on the market, and share prices go up and down like crazy every day, right? So to conclude this section, you either don't research and you gamble on your emotions, on what you hear about companies, or you can try to put in the time and effort to really do your homework. But even while you spend your off time or even your office time and weekends researching companies, you got to realize that you're competing against huge financial firms, right? Banks, investment companies, financial companies that have been attracting the best and brightest Americans, from the best Ivy League schools to do the exact same thing, right? They all want to figure out how to beat the market and get the most return on their investment, right? They even hired PhDs to write, algorithms, complex programs to try to figure out how to beat the market. They meet with CEOs and boards of directors to get the inside scoop on, what's happening in the industry, what their business plan is, all this stuff. They even visit factories and production lines, right? So do you think you can outsmart and outwork those operations, right? Do you think you're going to get something that they don't know, right?
Yes. Absolutely.
All right.
Money.
So how do these people and everyone else make sense of so many companies on the stock market anyway, right? They use indexes, right? Indexes are simply mathematical formulas used to measure the overall value of certain groups of companies over time. Right? So as each company, for example, these companies, Google, Microsoft, Amazon, Tesla, Dell, Adobe, Facebook, every company, there's so many companies out there and they're all doing their own thing, right? They're executing their business plans, trying to make a profit, right? Trying to provide a service or a product. And all their shares are traded on the market. and the value of those companies change every day. Right? If I want to measure how this specific group of companies are performing, I'm going to use an index. Okay, and all it is a some sort of formula or to output a value so that I can generally get what's going on with these companies, right? If the number goes up today, I can say generally this part of the market is doing good. If it goes down, generally this part of the market is doing bad, right? The main indexes that track the American stock market are the S&P 500, which measures the performance of the 500 largest American corporations, the Dow Jones Industrial Index, which tracks 30 big companies. I don't know how they choose. And the NASDAQ Composite, which tracks stocks on the NASDAQ stock market. Are there any questions on what indexes are? Yeah.
Can you actually repeat again what indexes are?
Indexes are simply a mathematical formula to determine how a group of companies are doing generally. So, yeah.
Do indexes change every year or like every month depending on how the market is?
There are, you can make an index today. You can create your own index if you want. And that's why I bring up these two. These are the main ones that have been in use. I think the first one was like 1840 or something, right? Some guy just decided to come up with a way to track how a certain group of countries are doing. He published it, and I think that's the history of the not the S&P, maybe the Dow Jones, right? So, like I said, like I did, right? I created an index, right? You don't know my formula, but I created an index right here, right? But the important indexes are the big ones, right? That you see in the news, right? S&P went up 200, whatever, right? Is that clear? Yeah. Okay, we're gonna move on. I'm gonna introduce what a mutual fund is. Okay, a group of people pooling their money together to invest as a unit is known as a mutual fund. Okay. A fund is simply a collection of money. Mutual just kind of means we're doing it together, right? These pools of money hire the smart people that we talked about earlier to advise them on what to invest in, right? You know, they're going to pay people full time to figure out what's the best way to invest their money. And these smart people generally advise the funds to invest in a diverse portfolio, right? Do you get the basket and the egg thing? Yeah. To account for the volatility of individual stock, right? You're not going to put everyone's money on something that might fail tomorrow, right? So they generally advise everyone, and they generally invest in a very a big spread of stock. They also offer funds that pick certain industries. For example, the Charles Schwab company offers the Schwab Healthcare Fund, which invests in health and pharmaceutical companies, right? So like I chose a group of companies at first, right? They simply do their own research and say, hey, this group of companies looks to be good next year. And then they create a fund and call it something. And then they take your money and they buy that stock for you, okay? Funds are suggested to newer or more casual investors because the risk of individual stock is mitigated by diversifying one's portfolio through different stock in different industries. Okay, any questions on mutual funds? All right, finally, the index fund is a mutual fund that is tied to an index. Okay, it invests in the same companies that are tracked by certain indexes. Index funds that track the entire stock market are considered extremely diversified. For example, the S&P 500 has 500 companies. And so an index fund that tracks the S&P 500 buys a little bit of the whole 500 companies. It invests in each of those companies for you. Okay. And there are even index funds that will track the entire American stock market as well as international markets. So you can get super diversified. Okay. Take a note at the graph on the right. This graph shows that the S&P 500 index, it almost completely mirrors the total market performance. Right? And this is because the size of the 500 biggest American companies really determines how the market goes. Right? The small companies that are worth like $100,000, whatever, you know, they barely register on the overall picture of things. Okay. Okay, so at first we mentioned that there were seemingly two ways that a stock will make you money, right? We said that in the long run, when businesses become more valuable through growth, through sound business plans, and as opposed to in the short run when the demand for their shares outpace the supply of those shares. We said that these are two ways that the value of your stock increases, right? Of these two, which do you think plays a bigger role in determining how much the price of that stock changes over time? Who thinks it's the first one on the left? Who thinks the second one? Second one? Second one is like the supply and demand thing, right? When more people want that stock, it'll drive the price up. Over time, you think? Like over?
Oh, over time.
Yeah, over time.
And the first one.
The first one? Okay. You're right. It's the first one. Okay. There's over time in the long run. There's actually only one way that the value of your investment increases. The value of your investment in a business increases. Okay. Here's a quote that kind of explains it. The legendary investor Warren Buffett said that the most that owners in the aggregate can earn between now and the end of time is what their business in the aggregate earns. Okay? He goes on to say, over time, the aggregate gains made by shareholders must, of necessity, match the business gains of the company. Okay? That's what I hear. So it's all about whether the thing makes money, right? So companies, they must make money to survive, right? If they don't make money, no one's gonna want them, right? So that's why it's actually remarkable that companies like Uber, right, they've been losing money for like 10 years, yet people are still investing in them. That's why it's remarkable. But generally, right, you invest in a company to make money. You start a company to make money, right? Otherwise, it'd be called a nonprofit. Right? So money means growth, right? It means they can hire more people, they can scale up their operations, and all of this is just to make more money, right? Money to shareholders in dividends also makes company shares more valuable. So when a company makes more profit and they generally decide to share this profit with their owners, that makes that stock more valuable when people know that, hey, that company paying out, right? So we want some of those stocks that pay dividends, okay? So of those two ways, right, it's even more extreme than you think over time, right? This research right here is done by John Bogle. If you don't know him, he's the founder of a firm that today manages $5.3 trillion worth of assets. Okay, so what his research shows, what this graph shows, is that the company's investment returns measured by their earnings growth and their dividend yields. Okay, maybe I have to explain those, maybe I don't. But generally they account for 99% of the market returns. Okay, let's try to break this down, right? This means that 99% of the increase in stock prices that people see as your investment gaining value are determined by companies increasing their earnings, making money, and also paying that out in the form of dividends. Okay. Let's see what this says. Who's confused? Who has questions, right? So let's see. So the market return, that's the numbers that are judged by the S&P 500, right? The market is where people trade stock, okay? So when I say Facebook is worth $50 a share today, right? That's the price on the stock market, right? So that's what's talking about market return, right? Of all the companies in America, right? The overall changes in these prices have been up, right? 9.6 per year. Okay, that's what the bottom thing is. Okay. Investment return is when you buy stock, right? When the company puts money in its operations, that's what it's investing. Okay. I might have made it worse.
Wait. So what's the point of this graph again? To see whether or not, if you go back to the last slide,
Yeah.
to see whether or not the left or the right is better.
Yeah. The point I'm trying to make here, we're talking about investing in the stock market means we're buying shares in a company, right? Let's just say we buy, Geico shares for $10 a share, right? All we're concerned about is that the value of that share goes up in value, right? That's all we're concerned about, pretty much, right? And I was making the point, what causes this price to go up, right? Is it simply that people like Geico and they just want more shares, and then there's not a lot of shares, so that just goes up over the last 100 years? That's how I'm going to make my money, right? Or is it because Geico is becoming a more valuable corporation? You know, they're expanding their business, they're getting more market share, right? They hire some really cool new CEO or what have you, right? And this, over time, if their company is more viable, they've been making a profit for the last 50 years, right? The point I'm making is that that is what accounts for the price of your investment going up, okay? And that's what this research shows, that the total market returns 9.6% every year on average for the last whatever the thing is, right? 100 years. What accounts for that is companies' earnings increasing. That means their revenue is increasing, right? Plus dividend yield is what they're paying out to their shareholders, which suggests they're making a profit. Right? That's what that means. Okay. Yeah.
So is the market return the corporation's averaging 9.6% in growth, and investment return is what the consumers are getting out of the equity they bought?
Investment return, not exactly, because it counts. Investment return counts what the company is investing in itself as well. So it's not just what investors are buying. Okay. Alright. We're gonna move on. Okay. Maybe we'll come back to this later. But the gist is that if inherently the business is more valuable and more viable and is doing well, that's what accounts for it gaining value, not whatever happens on the stock market every day. Okay. Actually, 1% of the discrepancy here is 0.1%. That difference is what Bogle says is caused by the everyday trading of stock, right? The supply and demand of those shares is only ultimately 1% of entire market returns. Okay.
So that 0.1% is speculation.
Yeah, that's what he called it, speculation, right? Okay. And it's also why Bogle says that the stock market is a giant distraction to the business of investing, right? Keep that in your mind. All right. Okay, so finally, that was like background information, kind of. Finally, the strategy, if you can call it that I'm introducing today, is one that discourages trading individual stocks in individual company, because only the smallest number of professional money managers can consistently pick winning stock over time. And you and I don't have the time or the resources to compete with those guys. Okay. I'll first show that the low-cost index fund is the best performing investment strategy over time, by the way. I'll next discuss the huge advantage that is the cost-saving feature of the low-cost index fund. And finally, I'll discuss the role of indexing in the big picture, okay, at the end. All right. So first, I said that I'll need to show how index funds consistently outperform mutual funds. Somebody want to remind the class what mutual funds are again?
It's people putting in money to buy stocks and
Investments.
Yeah.
investments.
It's like multiple
Correct.
stocks together.
Yeah,
It's not just one.
pretty much. There we go. Okay, here's some anecdotal evidence first, right? I got my first real job in like 2017, and I started investing with Vanguard, all in index funds. Okay, so this has only been, I think, 3 years, right? It's a very short time frame. Keep that in your mind, right? Especially given that, you know, hopefully I'm around for the next 50 years or so, right? So 3 years is nothing, okay? My 3-year total return is about 12%. On the other hand, Carmen was gracious enough to share her portfolio performance with us. She invested in individual companies, right? I don't have the individual companies, but do you remember what holdings you had?
I had Bank of America, Random Cannabis Company, and pharmaceutical.
Pharmaceutical, yeah. So Carmen's performance from February 2018 when she started to February 2020 is minus 7%. Okay. In the same time frame, is everyone good? Know how to know what this communicates, right? Pretty much is there. Since inception, her account was started on February 2018, and overall she's lost 7% of her initial investment.
Is it saying that she started at 29,000 and then ended at 28,000? Is that what it's saying?
She ended at 28.5, yes.
And she started at
29.5, correct.
Okay.
All right.
And
And-
the bottom part is market.
Yeah, since we're here, we can see that the S&P 500 in the same time frame returned 12%. So that's a difference of 19% over the last 2 years. Okay, and compared with me in the same time frame, what is it? 20. So total in that same time frame, I put 26,200, and I returned 3,400. I think that's like 13 or 13%. Right. So that's anecdotal evidence of trying to pick stock and the market overall. Right. Okay. I also have my dad's returns over here. He bought in. I tried, dude. He bought most of his shares about 10 years ago, 2009, like directly after the market went down. So he saw that shit was on sale, so he bought some stuff. So generally, what we see, right? We see. Look, he bought Bank of America in 2011. Today, he's made 100. He's made 70. He's up $7,700. He's more than doubled his investment. Okay, and also on the bottom, all right. He bought Citigroup, which is like Citibank or whatever. He's up $9,400. Intel, I had to do this math myself because somehow there wasn't the computer. Anyway, so in 2009, Intel was worth $18.79 per share. Today it's worth $66 per share, which is like crazy huge, right? So he's made $4,700, which is 250% of his initial investment. Okay, so he's doing good. So he got lucky, right, or whatever. So good for him.
What do they mean by unreal gain?
Oh yeah. So your gains are not realized. They're not real until you sell that stock.
Yeah.
Yeah. You don't have any cash. You can't buy anything with that. Yeah. That's why when they say Jeff Bezos is worth however much, most of that is in his shares of Amazon. So he can't spend that right away. Okay. Moving on.
So what you're saying is that
Yes.
we should wait for the next,
Crash?
crash.
Yeah, you
But
could.
everyone's been saying it's been crashing. It's going to crash for the past couple of years though.
Yeah. That's
So-
what I do.
It'll crash.
Yeah. You can expect dips and stuff.
But if you're like wait,
Yeah. So my dad bought and held these companies over the last decade, right?
with your help or he did something?
No. I didn't help him at all. Yeah. So, and trust me, he's not like, obviously he's not super literate and like researching all this stuff, right? He's just like, that was good. And you're like, yeah, that was good. So, yeah. And he's definitely not going to pay someone to advise him because he doesn't like doing it.
And we're talking today.
All right. So Carmen and my dad, so your mileage varies greatly when you buy individual companies, right? Because obviously, can Carmen tell me what Bank of America's business plan for the next year is? No, right? Exactly. Yeah. So there you go. Carmen and my dad could have chosen pretty much anything, right? They could have chosen PG&E or something that did even worse over the same time frame. Okay. Next, I'm gonna show you guys our work accounts, right? So I mentioned 401ks. They invest in the stock market as well because that's where they're gonna make the money to pay you when you retire. So what we have here, this is my employer, which is the federal government. They do a thrift savings plan, which is indexed, by the way. So it only shows the. I had two accounts because I work as a civilian for them and also a military one. So, anyways, all you gotta see is that they only show as much detail as your last year. But anyway, so from December 2018 to December 2019, the return on this account was 24%. And this is just the last year. God damn it. And Q's calling me. Let me just get him on the line real quick. Hey, keep it down now. I'm kind of in the middle of something.
So my bad, dude.
All right. So on the right side is very similar because it's the government account. My returns for the same time frame is 23%. And then in January, it averages to, from January 2019 to January 2020, it averages 15.5%. Carmen's work, she worked for UCSF for a while,
A year.
a couple years ago, yeah, a year. So, you know, you can read what's happening here. This is the time from 2018 to today. Even though she's not working for them, they still, she still has an account through them. So, anyways, what are we seeing here? She put in 8,400 over time since 2018, and I think what does that say? 15%. Yeah. Since she
January
started.
31st.
So basically, I contributed 3,946 in that year that I worked there, and UCSF contributed 4,500.
Who's there, dude? Who's
Hey,
there, dude?
shut up,
And
bro.
then now that I don't work there anymore,
I'm
I
trying to-
can't contribute
I'm
anymore,
really
but
trying
I
to
can
figure
leave
that
that money alone. So hopefully in 50 years it'll be like better than what it is now.
Mm.
That's
But in that time frame, it's already increased by 15%. Is that what you're saying?
Yeah.
Wait, and does it also continue to compound even
Yes.
Yeah.
if you leave?
I'm not gonna move it. I'm not gonna touch
You
it.
should.
I'm just gonna forget about it, and hopefully when I return and when I retire, I can grab some money.
Yeah.
Shit, isn't that like kind of crazy? Like 24% or 15%, and it's just.
Oh yeah. So last year was crazy. Last year was the whole market averaged 25%. Absolutely ridiculous. Like, I don't know. Hopefully it keeps going, right? You know. Yeah. So don't expect that, right? Expect it averages 7%.
7, you said?
7. Yeah, that's what, like kind of safe, you know. So the longer that you have data, right, the more you can expect it to be closer to 7%, right? But you know, if you ask somebody to guess what next year's return is, it can be anywhere from, you know, minus 50 to plus whatever, right? But anyways, keep a note also here that, you know, Carmen actually only paid 3,900 into this account. Her employer, very generous, paid 4,500, free money, right? So always maximize what your employer is doing. And when you're, you know, if you're lucky enough to be choosing different employers, right? Also ask them, you know, how much they're gonna contribute, right?
Also note that my current job doesn't do matching contributions, so I didn't open a retirement account with them.
Yeah.
So it really depends based on your employer,
Yeah.
their timing.
City-
UCSF is good.
City and county, they don't have matching, but they do have a pension program. So keep that in mind.
We get say that you ask employers for these kind of information, like who can you ask specifically?
HR, finance, yeah.
What if my HR got fired and they haven't hired one for the past like 3 months?
It should
They
be,
should have somebody. They should have somebody you can contact.
Or-
they
or-
have a department.
Just go straight to the top.
They have a department.
Whoever
So
processes your payroll.
yeah. Or even online, because you work for a big company. There should be information online. Yeah. All right. So we move on.
What's your investor TSP?
Huh?
You're good in G fund stuff?
No. So my
What's all the on the right?
civilian is L2050,
Okay.
and then I have like my country is like 30.
Doing 20 years?
Huh. What's that?
Doing 20 years?
could you
I
elaborate
don't
what y'all
know.
talking about right now?
Huh?
Could you elaborate what y'all talking about right
Yeah. So the federal government they offer different funds, right? So different funds are simply different stock that they invest in. So for example, they keep it simple, right? They only have 6, I guess you count that. They have 6 different funds. They have the F fund is a fixed income fund. So the things that they invest in are not risky at all. But what that means is that it will provide a lower return. But you know, they offer that for people who are, you know, old and they don't have time if the market crashes to see a recovery, right? And then they have more aggressive ones. For example, the international, their I fund, where, you know, you can call it whatever you want, but what they invest in are international companies, and that is generally more risky, but also more reward. Okay, we're gonna discuss that later as well. Andy, do you wanna move here? There's room if you want.
Mysterium?
All right.
They will like that.
All right, moving on. Oh, we're also I just also want to note that the fund that Carmen's in is also indexed. This is just this is what some details of that specific fund. And just to read it, this fund started in 2008, and since then they have 11% growth. Okay, just for your knowledge. Okay, next, we're gonna talk about some concrete examples. We're gonna compare the biggest fund on the market, which is Vanguard's total stock market fund, with literally any other mutual fund, and we're gonna compare their performance. There's a cool way to do that if you're shopping around for funds.
Wait, so the Vanguard, the VTSMX stands for Vanguard.
Total stock market fund. Yeah.
And that's an index fund?
This is an index fund. Yeah. Oh, by the way, it's weird. You always see these what are these letters, right? These are just ticker symbols. Facebook isn't spelled out Facebook. It's FB. So a cool tool to where's my mouse at? So all you gotta do in Google if you're shopping around for funds, right? So all types of financial institutions and banks, they offer all kinds of funds, right? So you're gonna be shopping around, and Google lets you compare it pretty easy. So all you gotta do is go to the fund and hit compare, and then you can type in some stuff. So I'm gonna start with this, right? Trust me, it's not cherry picked. We're gonna do other stuff later as well.
Oh, cherry picked.
Yeah. Okay, so Yahoo Finance published this article on January 30th, 2020, about a week ago. Hey, you should buy these mutual funds for your retirement. All right. The MFS Mid Cap Growth Fund, whatever. This is the symbol, right? Also, take note when shopping around. We're going to discuss this later, of course, but the expense ratio is 1.1%, and there's a 0.71% management fee for this fund. Okay. Oh, what does it say about it? Oh, this fund chooses companies with a stock market valuation between whatever. With annual returns of 12.39, this fund is a winner. EAMCX. So we're going to throw that in here. EA. And this is how you're going to compare funds. Okay. So, hold on. In 3 months, right? You see the performance is pretty similar, right? Mm-hmm. You can kind of ignore the price value of each share of a fund because we're talking percentages here.
Right, we care more about the growth, right?
Yeah. And if you put $30, if you have $30 to invest, right, you're going to be buying 1 point something of the MFS shares versus point something of the Vanguard shares, right? So you don't really have to care too much about the direct numbers here. You're looking at the performance, okay? So in the last 3 months, similar performance. 6 months, Vanguard's beating it. So again, Vanguard is the total stock market. Remember, this is an index. It tracks the whole market. And this just tracks certain companies that are however it decides, right? Year to date, actually doesn't matter. It's only been like a month, so don't worry about that. 1 year, it's beating the market in the last year. 5 years, it's trailing the market by 4%. Over time, it's actually very close to the market, okay? And you can see here, this fund seems to have started in 2002. Okay, what's next? Okay, Yahoo, Royce International Premier Fund. Expense ratio, management fee, always keep track of those. This fund produced robust 13.49 over the last 5 years, so they recommend it. RYIPX. Jesus. RYIPX. Same deal, right? 3 months is pretty similar. Last 6 months, exactly the same. This year, actually doesn't matter, it's only been a month. 1 year, pretty much the same. 5 years, it's on top. Over time, it's severely lagging the market, right? So this was since 2011. Yeah. So it's, what is that? 70% you're behind, right? So if you, theoretically, right, if you invested at this point, right, if you invested in this early on, you missed out on 70% returns. Okay, so what's next? All right, real quick. General Electric, blah, 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 right? GESSX. GESSX. All right, let's take a look at this. 3 months, lagging 5%, lagging 4%, 1 year lagging 2%, 5 years lagging a whole 45%.
Oh no.
Over time, trash, right?
I said trash. I said trash.
Yeah. So
Wait, search a VTI.
VTI, Vanguard, something total stock. It should be the exact
It's
same.
not, well, one costs more though.
Oh, does it?
We'll look at more like the cost itself.
We're not focusing on.
I know, but
Yeah.
that's the difference,
Oh,
right?
it doesn't say what the cost is here. Is that a ETF?
Yeah, I guess that's an easy.
Okay, so alright, so real time, right? Let's just Google, right? Fucking best mutual funds 2020.
I just gotta look it over.
Something that's not purple, alright?
Wait, I can't tell. Are they all blue or can't tell?
Yeah. Well, this one was purple.
But he clicked all of them.
Yeah, we-
No.
yeah, I can't
Well,
see
bro,
it.
I'll go to page 37, bro.
Can't see shit.
I don't know about you. Oh, we can do ETFs. I want lists. Page 4. I don't know what SIP is. Whatever. Let's give it a shot. Personalfn.com suggests some mutual funds for us. I need the ticker symbols, otherwise it's hard to look these up. Where is? Alright, this is too confusing, bro. Alright, let's go. Paisa Bazaar, best mutual funds.
You just look it up on the New York Times.
Yeah, well, I'm on like page 70, so that's why it's got these weird links. Where's the ticker symbols at, bro?
Been a professional on that.
Go to page 2.
There's no like New York Times or Forbes. Fine.
There we go. Investor Place, 10 best mutual funds for whatever.
Oh god.
Fuck out of here.
Oh, that's the one you're talking about.
Okay, so it suggests Vanguard, yeah. Well, I don't want index funds, I want mutual funds. Alright, Fidelity Puritan Fund. And it'll say some good stuff about it. FPURX. FPURX. Alright, similar, last 3 months. 6 months, trailing by half. 1 year, pretty close, I would say. 5 years, not even close. Over time, not even close, right? And this is, this is just a total stock market, right? Nothing fancy, just a little bit of everything. All right, what's next? We go over here. American Funds, Washington Mutual, AWSHX. AW, I forgot. HS, SA.
There you go.
All right, 3 months, half, 1 year, trailing by 9 points, trailing by a lot. All right, so, anyone want more examples? We good. Pick any fund, and for some reason, they trail the market, right? And these funds, if I have to remind you, was people pulling their money together, and then these group of people hiring really smart people to suggest where to invest. And somehow, right, they're losing to the market. That's crazy. Right? All right, let's go back to my thing.
Oh, just to clarify, when you're investing into that Vanguard stock,
Uh-huh.
are you investing in the entire stock market itself or something like that, or like?
Yeah, like I
Okay.
said, it takes your money and it buys a little bit of everything.
Okay.
Okay.
So it's just automatically disperse your money.
Yeah,
Oh,
it automatically. And you can look into exactly what percentage of their assets are in what companies.
So what you're saying is
Yes.
that investing in the market and generalizing it
Mhm.
is way better than to like picking a section or like certain
Precisely, yeah.
That's the strategy. You're
That
talking
is,
about.
yeah. That's why it's not really a strategy, but it's somehow the best performer.
But if let's say the market were to crash,
And it has. This
and then you
includes.
start buying all of them.
Yeah, this includes the depression, the recession, and every other dip in between. So, all right, we're gonna move on real quick. Don't want to take up too much time. Dude hung up on me.
oh man.
Okay. Where are we at? So, you can literally put any mutual fund, and you can find that it outperforms the market. Maybe in certain windows, maybe throughout the whole thing, right? But you also saw that the mileage really varies over time, right? Within, you could pick 3 months here, 3 months there, and you do get very different metrics, right? So January to May of one fund could see a return of 100%, but in the same year, August to December, you can lose 200%. So consider that when people try to tell you how these things perform, right? And keep in mind, we're going to be around for 40, 50, 60 years, right? So think about the long term. All right. Just to demonstrate that your mileage varies, right? This is me from January 19 to December 19. Like I said, last year was a great year. I invested 9,400 total, and I returned 4,500. And if I do the math, I was like 50% return, which is ridiculous, right? However, from September 2018 to December 2018, which is just a few months prior to 2019, I was down $1,700, right? So, time really matters, like what window you're looking into it. Trying to time this and, like I said, catching, trying to get in at like the low points. Is today a low point or is it going to go lower tomorrow, right? And then trying to time the great leaps of the market, right? Is first of all, I don't think it's possible, right? And if you think you can do it, then you can try. But for the average Joe, especially, right, probably not going to happen, right? It's about how much time you're in the market, right? We saw the long-term returns, right? So keep that in mind. All right. Over the long run, the market has always won, right? It's just always grown, right? Amazing. Now for some more professional research on the question. I'm going to move somewhat quickly through this. Okay. So and the New York Times did a contest for 7 years. They asked 5 respected advisors how they would invest $50,000 in a tax-free account holding mutual fund shares for at least 20 years. They compared that performance to the returns earned by the Vanguard 500 index fund. Okay, the results are on the right. This was only 7 years later because for some reason they stopped publishing the reports after 7 years of the contest. And some people say it's because the advisors were too embarrassed to keep going.
This is in 93?
This was in, from 1993 to 2000, they had this contest. $50,000, right? So they asked these firms to invest, and you'll see their end result, right? They averaged a return of $88,500. This is from $50,000. They returned this much. The highest being $105,000 by this firm right here, Fidelity. But the market, in the same time, if you can't see, returned $138,000 from an initial $50,000. So that's one data point for you guys. All right, next.
What's the index 500?
It's a fund that Vanguard offers. Yeah. So
you're advertising us to buy that fund.
Yes, pretty much. but so this is a big no. So this is a big responsibility. Like, I can't tell you to invest because obviously it's your money, right? But the same thing why I'm doing this because it was my money the last 3 years. So you best bet that I was doing my research, right? I didn't want to lose any money, right? So anyways, next data point we have is in 2006, Warren Buffett made a wager, said, I bet that an index fund will beat any of you guys who think you guys are hot shit on Wall Street, right? So he bet $1 million for 10 years, right? That his simple investment in the Vanguard index fund would beat the efforts of a hedge fund. So now, since I brought that up, I just have to explain real quick. A hedge fund is like, it's a fund, right? But if you look at the definition of hedge, you'll see that it has something to do with betting and gambling, right? What they do is very complex. They don't simply buy simple shares of companies here and there and try to wait to see if it goes up and down. What they do is complicated and intricate betting on different type of behaviors that different type of stocks will perform. If you heard about like shorting market or like, making calls or puts, whatever. So I haven't researched this because I'm not into this. But generally these guys, they take risky investments, but they pay off big sometimes. And so anyways, they think they're really smart, right? They think they have the algorithm down. They think they have some inside information, or they think they have an edge on the market. Anyways, he bet these guys. And what do we have here? Do we have the results?
No.
Yeah, it's down here.
Oh,
okay. Yeah. So after 10 years, the S&P returned 7.1% on average, and the funds returned 2.2%. This is annual average. So they lost. Okay. And actually, this story is on a podcast that I will share with you guys. It's good. The advisors included a someone that managed the Yale's endowment extremely successfully in the last 10 years. And also, a fun fact is that Warren Buffett, just a couple years ago, he wrote a letter to his wife that he released. He instructed her to invest all his money in an index fund when he passed. Okay, so that's just an endorsement of Warren Buffett. Okay. Next data point is in 2010, Eugene Fama and Ken French. Ken French, by the way, is the president of the American Finance Association, and he's a professor at these respective schools. They did a study called "Luck versus Skill in the Cross Section of Mutual Fund Returns." So they're trying to figure out whether or not a mutual fund's return actually had anything to do with the people's skill, right? Because every single fund is going to market itself as, hey, we got something that the other guys don't. Give your money over here, we're going to give you back a lot more. Okay. They analyzed thousands of funds. Ultimately, they found that the top 2 to 3% of funds had enough skill to actually cover their costs, the cost of just operating. The other 97 or 98% did not even have that, so they lost money. Okay. In the extended interview, by the way, this is Freakonomics interviewed these researchers. French said that most people, including the biggest money managers, suffer from overconfidence, resulting in what amounts to simply gambling with other people's money. Okay, next data point. The Wall Street Journal, they did a long series chronicling the rise of passive investing, reported that over the past decade, between 71 and 93% of U.S. stock mutual funds either closed or failed to beat their closest index funds. I have a link. I'll share the link on the website if you guys want to look into this Wall Street Journal reporting. Next, Bogle, he's been doing research on this topic for the last 40 years. He said that if we go back to 1970, we find that there were approximately 400 funds that were in business from 1970 to the time that he did his research. And basically 330 or 340 have gone out of business. It turns out in that period there were only 2 mutual funds who beat the market by more than 2% every year. That's half of 1% of all the funds that originally started. So those are your odds, right? If you're picking mutual funds, those are your odds. Next, that's a lot of text. This is from Eugene Fama. He was in that previous study, but if you're not familiar with him, I'm not that familiar with him, but apparently he's like the grandfather of finance or something. He has a Nobel Prize in economics, University of Chicago School of Business professor. Okay, he said that I don't know anybody for whom active investing is worth it, because he said I've analyzed more stock than almost anybody, given that he's so old. He's like 85 now. But the problem that people don't understand is that active managers, almost by definition, have to be poorly diversified. Otherwise, they're not really active. They have to make bets. What that means is there's a huge dispersion of outcomes that are totally consistent with just chance. There's no skill involved in it. It's just good luck or bad luck. You can't tell the difference between the two based on returns alone. This is looking at the world before costs. When you look at the world after costs, which is what the people pay, they have to pay the cost of the people charging them. And then ultimately, the whole industry looks pretty bad. All right. We're going to move to cost next. So, index funds have been around since 1974. From then until now, initially started with 11 million in assets in index funds in 1974. Today, more than 11 trillion. Okay. So there's a lot of scholarship on the subject. You guys do your research before you invest. But we're going to move on now to the second great advantage of index funds. Okay, this is that they're low cost. So let me introduce active investing versus passive investing. Right, can anyone take a guess based on what I've said before, what the difference is? Right, you should be able to infer what active versus passive means. All right, nobody. All right, so active. All right, Roy, what you got?
Yeah, active is like trying to look at the market and like really trying to predict what's gonna happen, whereas passive is more
Get some money at the
And go
market.
ahead, invest, go
Mhm.
ahead.
Right. So exactly. So active obviously implies that somebody's out there doing something, right? You're paying these smart people to figure out what the best way to invest is, and that costs money. So that is the main reason that there's a huge cost difference between index funds and mutual funds, right? Index funds, you just write a formula, right? You can adjust the formula, what have you, but it just spit out. It finds out the percentage of each company to invest. Okay, as opposed to active, where somebody is getting paid very handsomely in New York to run some numbers and write a recommendation. Okay, and that is more or less the main thing behind cost. I think we take a break here, like 10 minutes. Yeah, intermission. Yeah. All right, folks, we're gonna keep pushing through this presentation. Okay.
You're so close to the screen.
Okay, so we have seen over this afternoon.
Good evening.
Okay, so the market has been growing and returning as a result of the overall growth, productivity, and success of thousands of companies over the last 100 years. The point I want to make now is that investors return what the market returns. Okay, and this is a very important point that I want you guys to get. So I'm going to draw a diagram out real quick.
You want someone to hold it?
I'll just draw here since and I have a small one too.
Some of the holders were
No.
But it's hard to like write on. Okay, guys, check it out. I'm gonna do a sick diagram. Okay. All right.
I don't know.
This
Let's see that.
This is the market. Okay. The market grows over time. Okay. It gets bigger. And the difference from here and here is this bigger part of the market, okay? So let's say this is like whatever, 1930, and this is like today, right? So we're gonna call this Jesus. This is the market return, right? This is the difference. This is the growth over time, okay? Investors are you and me, right? Like this, right? We buy shares of individual companies, right? So we have a piece of this big pie that we call the American stock market, okay? Maybe for some people it goes up, maybe for some people it goes down, okay? But what we return as a group, right? Every single investor, which maybe will be everyone here, right? We're investors as a whole. What we return is the market return, right? Except our return is called, how do you write an N upside down?
Do you need help, sir?
You got it, that's it.
Alright. So the market does its thing and it grows, right? But our return is the market growth minus costs, taxes, and fees, right? So we don't get all this for free, right? We pay people and they're gonna charge us, okay? So this the point I'm trying to make is that we only return what the market has returned minus our costs, okay? Any questions? Cool, moving on.
Wait.
Yes.
Say that again?
I fell asleep for like 5 seconds.
This is the market.
Yes.
Okay. This means all American companies, shares of them on the market. Over time, it grows, right? We've seen that. See that it grows right here, right?
Mm-hmm.
Okay. Investment return is this, right? This is what the market is returning over time, right? Obviously, there's new markets coming on, markets die. New businesses coming on, businesses die. But as a whole, right, this is the difference between here and now, right? And it'll continue to go bigger, according to history, okay? my point here is that investors, right, they put in money to this market and they expect the companies to do something with it, get more profitable, right? And they do, right? Generally, over history, it's been great. But they don't get exactly the return of the whole market. What they get is the return minus their fees, right? Cost, taxes, and fees. Okay. Like I said, some people lose if they make bad bets or whatever, but we're talking about investors as a whole group, right? Questions about this?
So what you're saying is that me as an investor invest $100 on the market, I also have to calculate the taxes that is put on my investment plus the
Yeah.
fees that's on my investments. Then in the end, even though I invested like $100, my return would be like after all these fees and taxes.
Yeah. Remember, I pointed out the expense ratios and management fees on some of the funds. That's what I'm talking about. So take note that active investors and passive investors, we're all investing in the same market, right? There's only one American stock market, right? When you're talking about another market, you're talking about like the Hong Kong stock market or whatever, the London stock market. But obviously the difference between active investors and passive investors who both invest in the same market are that active investors pay for people to advise them on which specific section of the market to invest in. Right? Passive investors also pay some costs, but they make the closest to the market return, right? Because they're minimizing tax costs and fees. Okay. Active investing, therefore, is a negative sum game. Ken French, a scholar, said that normal investors don't understand the negative sum nature of active investing. Whatever you win, I lose. Whatever I win, you lose. And we both paid to play that game. Right. So all the trading of stocks like individual every day, right? That's what's going on over here, right? You could be this person or this person today, right? But ultimately, businesses as a whole gain value over time. Right? The only people that are certain to make money in all this are the people who facilitate the trades, the middlemen, right? That say, okay, I mean, you could go somewhere for less expense to make the exact same trade that you're going to me for, except I charge you $5 per trade, right? Back in the day, it used to cost a decent amount of money to ask a brokerage to make that trade for you, right? Like a casino, the house always wins, right? The middleman is always going to win on this. The index fund strategy is based on finding the absolute lowest cost so that investors can capture as much of the market's return as possible. Let's talk about the long-term impact of costs. As returns compound, so do costs. Consider this projection of returns. Right? In the beginning, the gap, it's not large, right? 10%, barely see a difference in your returns on the same investment, right? But over time, you can see that gap become very significant. Right, so we're talking about, for example, $10,000 over 50 years. The market, this is fake numbers, by the way. If the market in that time period return average 8%, but you have a total of 2.5% fees that you have to pay your broker, right? Your returns are now 5.5%. And the difference here is extremely significant, right? 8% compounding every year gets you $469,000 in the end. 5.5% only gets $145,000. It's money on the table you're leaving off, right? And so these numbers can change, of course, right? If the market only returns 6%, what have you, your costs are only 1%, what have you. The point is that, simple math, right? The difference is also going to grow wider and wider as time goes on. The difference between your return and the market's return, the difference between your return and the market's return will always be the amount you are paying in costs and fees. Okay. This difference, because it's a percentage, it will compound over time, and with the same numbers we had at first, we see that guys can see, we see that. Excuse me. You can see the difference here, okay? So, 10, 20, 30, 40, 50 years, your total return versus the 5.5, versus the market, that's just what it shows. All right, cool. Unnecessary costs will continue to rob you of your share of the market's return over time, okay? It's just simple math. Any questions on this point? All right. We've shown that the market will continue to do its thing, right? It's gonna continue to beat people who think that they have an edge on the market. They're gonna, a lot of their fees are in marketing as well, trying to get more investors into their fund, right? So all this adds up. But they think that they can beat the very intricate and complex market of a nation of 330 million people. It's the same fallacy that happens when intelligent people go to a casino and say, "Hey, I'm gonna do better than everyone else," right? When in fact only one person does good, and it's the casino or the state lottery, what have you. Even though they know the odds, they enjoy the fun of it, right? And that's why some people make ridiculous bets on the market because it is kind of fun. But ultimately, for disciplined investors who want to minimize their costs, we should always go with the safer bet, the more sure bet. Okay. I'm gonna spend a bit of time to explain how Vanguard is unique and why I invest with Vanguard. Vanguard was the first index fund created by John Bogle in 1976. Like I said, it grew from 11 million to 5.3 trillion in assets today, and it has completely revolutionized this whole concept of investing in the last 40 or 50 years. Okay. What we got? Warren Buffett once said, "If a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice should be Jack Bogle." Same guy, Jack and John, same thing. Bogle's proven strategy resulted in, it's an undeniable victory according to the whole industry, and ultimately greater and greater market share. Just a few points to explain how it's leading the industry. On October 2nd of last year, Charles Schwab announced that it would no longer charge trading fees. The day after that, TD Ameritrade, which was another company, did the same thing, as well as E-Trade. They're now choosing to seek revenue from somewhere else in their business model besides these costs, because John Bogle's been relentless in the last 40 years telling everyone they're ripping us off, and his message is getting across. Also, Fidelity just recently is now offering a zero-fee index fund just to compete with Vanguard. Vanguard doesn't have zero fee, right? But Fidelity is now offering a zero-fee index fund, which will obviously, you don't have to pay anything, and they'll invest your money according to the index, and you'll see the gains. So you can keep that in mind, check it out. So other firms have caught up and caught on to what general investors like us are catching on to based on what Bogle's been saying the last 40 years. And the market is changing now to reflect this. So costs have gone down dramatically, okay? But what they haven't emulated is Vanguard's unique structure. And that's because they haven't embraced the concept of fiduciary duty that Vanguard has. Can anyone explain what fiduciary duty is? Fiduciary duty is it's a legal concept that says that if you're managing someone's money, you have to act in their best interests, right? So you can be sued if you're a money manager and you're somehow found to be not managing the money to your client's best interests, right? But Vanguard's unique because they take this concept to a whole new level since the beginning. Okay, it's the only firm that's owned by its shareholders. So here's a diagram that shows the difference in structure of Vanguard and other companies. Okay. So traditional firms have fund shareholders are us, right? We buy into the fund, so we own shares of that fund, right? So we own the mutual fund, right? But what the mutual fund does, the mutual fund has its own board of directors that decide what to do with the money, right? What they do is they hire management companies, right? Management companies are the people with the so-called expertise. Maybe they have, they have the algorithms, they have the research, whatever. They say they know how to invest the money. But they contract with these guys who tell them how to invest it. But these guys itself are a company, and this company has its own shareholders, right? And its own shareholders, they only control the management company. They have an interest in the management company making a profit, so that these shareholders will also get a profit, right? The difference that Vanguard has is that as Vanguard investors, we own the mutual funds, right? And then the mutual funds, the funds itself, they hire people that are employees of Vanguard to be the advisors, okay? So they don't have to, pay an expensive contract with another group of people who have their own interests in mind. And this structure is what has allowed Vanguard to offer the lowest fees in the market for the last 30, 40 years. That is changing now. Like I said, the market's catching up. And when other people are offering lower fees than Vanguard or even free index trading, that's a loss leader, right? If you're familiar with loss leader, it gets people in the door. That's not where they make their main money, but it gets people in the door to their company, and they're expecting to make up the revenue elsewhere. Okay. So after reading much of Bogle's work for this project and also for my own investments, he wrote like 10 books. I read like 8 of them. Right. Bogle's commitment and dedicating his whole career to reducing costs to the average shareholder. Plus, if you read his interpretation of what the role of a mutual fund company is, or what the role of a stock market is in our bigger society, he's gained my respect and loyalty, and that's why I invest with Vanguard to this day. Maybe someday some other firms might decide not to go this route, but as of right now, these guys are making good money, right? So, okay, that's all the time that I have to pitch Vanguard. So we're gonna move on to, let me read these quotes to you. I forgot I had this slide. This is John Bogle's words, just to give an idea of how he sees everything, right? These money managers are too often inclined to put their own interests first. It is surely one of the greatest paradoxes of the day that the largest financial rewards in our nation are received by an investment community that subtracts value from its clients. Remember, all those guys make their paychecks by taking a bit of your share of the return of the market. Okay. We must seek a financial sector of a size appropriate to its capital formation responsibilities, an investment sector in which a culture of stewardship and longer-term thinking dominates a culture of speculation, short-term trading, etc. Right. Big picture.
Then you forgot to put a picture.
Okay, so the basic premise of investing in the American market is that it will continue to grow as it has. If the entire economy contracts for a significant amount of time, we have bigger problems to worry about than our portfolios. Okay? An extended contraction, like a depression or a recession, right, means that public trust and faith in the system, or people's hope and people's idea of certainty and stability in American society, is severely impacted. Right, that's what happens when a recession happens. Okay, the supply of capital shrinks. It becomes too expensive to borrow money. Interest rates will skyrocket because people don't trust others to pay them back, and so money gets expensive. Results in less money moving around the economy, less businesses being started up, less jobs, less customers, people will start to buy less, companies will lose revenue, employees get laid off, productivity continues to drop. So that's what happens in an extended contraction of the economy. And so when that happens, we have we have bigger problems to worry about. Okay, Turkey, Greece, Argentina. Is that how you say it? Anyway, Argentina. Yeah, that's that they've been in the news recently. So and that's what happens, right? So let's briefly talk about why we can continue to expect growth in the American stock market, and also why we might not. Okay. So technology. So what we have here is productivity will continue to increase as technology capabilities increase. People will continue to want to start businesses. You know, they don't want to work for a boss, so they're creative, what have you. They will continue to do so. Society will still encourage entrepreneurship. Population growth continues in the U.S., which is a very important factor in a growing economy. There's more customers, more things to sell and trade, what have you. A more connected economy based on technology, social media, what have you, makes it easier for people to do business, and so this is all good news. So more people will participate in the economy, spread their money around, and also political stability is obviously very important in people believing that their business efforts will result in long-term success for themselves and therefore everyone else. Okay. Some reasons why the market might stop growing, and therefore this is a bad idea, right? If America plans to stop being America in 10 years, why would we invest long term, right? So why would we be concerned, right? If, for example, government grows and destroys markets, for instance, you know, if right now the healthcare industry makes a lot of money, right? And now we're talking about, you know, the government taking over healthcare, for example, like in Japan, where all doctors are government employees, right? When we do that, then there's no profit motive in the healthcare industry. So that whole market shrinks, and you know it's not a viable place for us to put our money because there's no money coming out of it, right? If property rights are somehow diminished, then you know why work hard if someone's going to come take it anyways, right? So these are some things. If taxes increase and they reduce profit margins or make earning a profit too hard, then you can expect the economy to slow down, right? At least theoretically. Maybe in a post-job economy, right? If somehow Andrew Yang wins the presidency and gets his basic income going, now some people simply don't have to work. And we're in a post-job economy, and therefore people decide not to work, and then if you have a business, you can't find workers, what have you. So these are just some ideas of why the market will stop growing, right? Or if there's an epic disaster, like a huge meteor and wipes out, half the population, obviously the economy will contract, right? So essentially when the market fails or when the infrastructure that allows for entrepreneurship weakens or is permanently destroyed, that will be where obviously we got bigger fish to fry, but that would be where your portfolio goes to shit, right? So, based on these considerations, we can judge whether or not a long-term investment in the American stock market is wise or unwise. Let's see, Bogle said that we know that investing entails risk, but we also know that not investing dooms us to financial failure. We have to invest in something to build wealth. Or you can start your own business if you want, but that is an investment as well. But we should also remain mindful of the big picture and keep in mind what tomorrow can possibly bring. But we should also note that with the help of decisive government action, the American stock market has recovered from the Great Depression as well as the recent Great Recession and everything in between. Right. We've recently just hit an all-time high on the market just a couple weeks ago, and we are currently in the longest running bull market or expanding market since 2009. Okay. All right. So in conclusion, I'm giving this presentation to spread some knowledge of investing and proper money management, so that you can build a foundation that should provide for you and your families some financial stability from here to the near future. Okay. I do this so you won't be limited by a mindset of scarcity and think that the rat race that we find ourselves in is some permanent or unchanging reality. Okay. So with greater perspective and sound foundations, we can appreciate abundance and begin to extend empathy to others, to develop the emotional and social capacity to work to better other people's lives and not just our own. Here are just like some stats to show in the big picture how much we have as a community. We got empty homes out here, vacant lots, all kinds of food waste. Okay. Anyways, I like to remind everybody that money is actually just a figment of our collective imagination. It's immensely useful to gauge the value of goods and services, but in many areas it is inadequate and actually inhumane. The possession or lack of money is disproportionate to human experience. Okay. At this point in history, nothing about the value of money in our society can excuse the amount of human misery and stress that is, at this point in time, artificially maintained. We should continue to work toward a society that properly defines the role of money in relation to the human experience. A role that allows for more joy, peace, creativity, passion, what have you, instead of the stress and anxiety that it causes to a lot of people today. I want to conclude with, of course, before we engage with any type of work that tries to help other people, we got to take care of ourselves. And so I hope everybody in this room and our community has their needs met, manage their money wisely, right? So we're not all stressed out all the time. Finally, it's kind of paradoxical that we have to play the game and understand the game and beat it in order to change it, right? All right, so that's pretty much it. I will take questions and we'll have an open discussion.